There must be some kind of preemptive moves that investors can do. What's the best thing to do? If you are buying bonds, keep the term as short as possible. Is there some kind of a floating rate instrument that they could get into?
Certainly, being in a 30-day T-bill, you have the least risk, a Government of Canada Treasury bill for 30 days, but you get the least yield. You get sort of 0.6%. If you go out to a year, you get a bit more than that. If you go out to 5 years, you get 1%. So the shorter the term, the sooner you get your money back and the sooner you roll over at higher interest rates. So you give up some potential income going from 0.6 for a 30-day Treasury bill to 1% for a 5-year bond. 0.4%, does that compensate you? Okay, we think not. And then if you look at a floating rate bond, instead of saying, I'll buy a bond for 5 years that pays me 1% a year for each of those years and $100 at maturity, you can buy a bond that says, I'll pay you whatever the floating rates are at the time. So if rates go up and down, you follow rates up and down. Clearly, in the last 10 years, with rates falling, you got less money, but you stayed at $100, your coupon interest dropped. Okay? But when rates rise, pretty well the only thing you'd want to own would be a floating rate bond.